Okay, so I am making a training, like an online digital course that will be on demand that you could watch anytime on hotel accounting. But I haven't gotten the time to make it yet. I haven't gotten it all put together. And people asking, like, when is it going to be ready? And I really don't know because I have a lot of hotel accounting to do. So I am going to challenge myself. So this is going to be like a built out course with, a lot of examples and questions and stuff. But I'm going to challenge myself I'm going to try to do it in 1 minute. Explain hotel accounting, just the basics, to get people kind of a basic understanding of what hotel accounting is in a minute. I really don't know if this is at all possible, but I'm going to try. And see if I am dragging out making this course way too long. Maybe we could just get it all settled right here. You can have it for free. Take it a minute. We'll see what we can do, okay? All right, so first we're going to go over the different softwares that data has to flow through. So your POS is anywhere someone swipes a credit card that's not at the front desk. So at a restaurant, at a bar, at a spa, anywhere outside of the front desk at the hotel. So that is where your sales and your payments and your taxes are collected in a POS system. That data has to flow to your PMS. So that is your front of the house software. That's at the front desk. So when a hotel guest comes and checks in and checks into their room or swipes their credit card at the front desk, all of those sales and payments and taxes get recorded in the PMS. And then that flows to your back of the house accounting software, something like QuickBooks or M3 or Inflow or something like that. And that is where your POS data and your PMS data has to end up in that back of the house software, and then your expenses get recorded and your financial statements get produced. So in the back of the house software, you're going to have an AP module, an accounts payable module. That's where you're going to enter vendor invoices to get paid. You can cut checks out of that module. There's also going to be a bank reconciliation module where you reconcile your bank accounts and make those journal entries and make sure all those payments that came in through your PMS that they're actually hitting the bank. And then also any other miscellaneous journal entries that you need to make, like recording payroll expenses or making accruals for the hotel. So let's talk about the differences between accrual and cash accounting. So cash accounting means you record sales whenever cash hits the bank. Everything is recorded based on when cash hits the bank. So you wouldn't have any receivables. You wouldn't have much on your balance sheet in cash basis accounting. Hotels, on the other hand, are accrual basis accounting. So you're going to have receivables and you're going to have payables. You're not going to record things just based on when cash hits the bank. You're going to record revenue based on when it was earned and expenses to match the revenue that they created. Okay, so aside from being accrual basis accounting, another standard for hotels is USALI. So that's Uniform System of Accounts for the Lodging Industry. And that's going to give the full listing of accounts that are going to be in a hotel's chart of accounts and kind of the rough outline for the balance sheet and income statement. So a chart of accounts is kind of the foundation of an accounting system. It's every single specific line item that can be on the financial statements. So when the sales come in through your PMS, they're all going to be mapped to an account on your chart of accounts. When an invoice gets coded in accounts payable, it's going to go to a specific account in your chart of accounts. And those accounts are what make your financial statements. So in the full listing of your chart of accounts, it's going to be your balance sheet accounts first, which is assets, things that the hotel owns, like the building and inventory, and your cash accounts. So things that the company owns. And then that is equal to your liabilities and your equity. So things the company owns, and then on the other side, your liabilities and equity. Liability is outside parties that have claims to those assets, and equity is ownership's claims to those assets. So what the company owns and people's claims against those assets. So those are the balance sheet accounts, asset, liabilities, equity. After the balance sheet accounts come your income statement accounts or profit and loss statement accounts. So those are revenue and expenses. All revenue and expenses basically is your entire income statement. Your sales or revenue minus your expenses equals the profit or the net income for the property. So the net income on your income statement, it flows back up to your balance sheet as current earnings. So the balance sheet itself is actually a snapshot of how the company is doing at that one specific moment in time. Although it's part of the accounts, since we take that total from the income statement and plug it in up here under current earnings, it is actually the entire picture. So it's that financial statement that encompasses the entire chart of accounts, even if the income statements aren't listed out specifically. So the income statement is a little different in hotels than other industries because it's not all of the revenue and then all of the expenses listed in your chart of accounts. It's kind of mixed up a bit. It's departmentalized. So there's the rooms department income and expenses, and then the food department income and then expenses, and then the beverage department income and expenses, and so on. So your income statement itself, it's going to have a summary page, which is just formulas that adds up all the different departmental totals to get to your bottom line or your profit or your net income. And then it's going to have several pages after that shows the departmental income statement. So what your net profit was for just the rooms department and just the food and beverage department. And then after the departments that bring in revenue, there's the departments that don't have revenue associated with them, like admin and sales and maintenance. Okay, the third financial statement. So that's the balance sheet and then the income statement. And then there's the cash flow statement, which is the third statement I want to talk about. And it kind of marries the balance sheet and the income statement together because people's tendency is to look at the income statement, to see that bottom line profit and say, hey, we made 100 grand this month. That's how much should be in the bank account. But remember, we talked about accrual basis accounting. So things are not recorded on the income statement based on when money hits the bank. So that 100,000 in income can actually have depreciation expense included. So if we think about that, depreciation is not something that's based on cash. It's just the wearing out of your building. So if you expensed out 50 grand, that reduced your bottom line income, but it didn't reduce your cash in the bank. So say you increased your inventory by 20 grand. Well, that would cost you 20 grand in cash, but it would be on your balance sheet in your inventory account, not reducing your income statement, not reducing that bottom line of your income statement. So it starts out with your net income and then it adjusts it based on all of the balance sheet activity and the effect that those entries had on cash to get to the bottom line of what actually happened to your cash account that month, whether it increased or decreased and by what amount. So those are the three main essential financial statements. The fourth one that I want to talk about is a trailing 12 income statement. And I talk about this one a lot because it is very, very useful in operational accounting because it's an income statement. So it has the same rows as a normal income statement, but it has all of the months next to each other, column by column. So it makes it very easy to spot trends. So you can see, okay, electricity was $4,000, $4,000, $4,000, $8,000. What happened? Or, another expense has was consistent and then a big old gap. Like, hey, where's that invoice? We probably need to accrue for it. And then we probably also need to be calling the vendor to try to collect it. So that is very, very useful and something that I think should be reviewed every month. It's very practical and easy to spot trends. Okay, I'm sure that was more than a minute. I'm sure there was tons of detail I left out. I'm not even sure if what I said was clear, but there you have it. That is kind of a general broad overview of hotel accounting from the first credit card swipe to producing the financial statements. You can always let me know if you have any questions, and I am going to get that training out sometime very soon. Looking back at that recording today, I can see now that even when I sped it up, it was nowhere close than 1 minute. So hotel accounting from A to Z in less than 10 minutes. How about that? And also I can just already think of all of the things that I didn't get time to explain or that could have used a little more explanation. So having visuals and samples and downloads and all of the resources that will go along with the training, I'm sure will help. But I would love to know if there's anything that I didn't cover, if you particularly want anything to be expanded on or covered in the training, or maybe just quick little things that I could answer for you now. I'd be happy to do that. So like this video if you liked it, and let me know in the comments what else I can help you with.